Hey Shane, how's it going?
It's going, man. How are you today?
Doing well. It's been a busy day, just finish up and move out. And it's funny, I was driving and almost ran out of gas for the first time. And it's kind of funny bringing that up. And I do that intentionally because, said I had 1 mile left. People do that all the time, the check engine light or whatever flashes. And it's not until you're in my situation where no cell service and I had 5 miles to go with that 1 mile of gas. And I'm like, it's kind of like in your portfolio. I was just thinking about it. Is right now, fundamentally, it is the economy is flashing. Like, be careful, and you don't want to try to push the limit until you finally just run out of gas with no service. And in this situation, that is, it's the active stops. It's knowing levels to just trim a little bit, and hard market to read right now. And I think that's just the key to success.
Wait, well, so yeah, that's that doesn't happen very often in Florida. I remember that happening in Colorado, where you're like, "Wow, I'm not going to have service, and I'm on the wrong side of such and such mountain, and this is not going to work." But we don't have that problem in Florida. There's pretty much a gas station every mile, and there's self-service pretty much everywhere. So that's funny. Haven't thought about anything like that in a long time.
Yeah, it's always interesting when no cell service and 10 miles each way to get to a gas station.
So you
But
made it though? You didn't run out?
I did. So apparently the gauge they give you that tells you how many miles you have, they build in a little cushion. So
Yeah, of course they do.
yeah,
It's
but
funny though, it's a good analogy because I mean, I remember that happening before, and you turn off the air conditioning, you try to tone it down to like 55 miles an hour where you get better gas mileage. Like you do all these really smart things that you don't do when you're being aggressive, right? And so kind of the same idea in the markets right now is just like take your foot off the gas pedal a little bit. Turn down the AC, maybe open the windows, smell the fresh air, kind of get a sense of what's going on and like be a little bit more cautious, you know?
mhm.
So, and don't forget to fill up with gas at your next opportunity.
You bet. So,
That's funny.
but today's September 8th for those watching, and this morning was interesting. So we had the European Central Bank raised rates, 75 basis points instead of 50, and then I missed Jerome Powell because I was freaking out about trying to make it to the next stop. But
Hmm.
I don't know if you had any takeaways from that, Shane. And while you're just
No,
talking,
it was boring. It was boring. Sorry, I didn't mean to cut you off, but yeah, it was totally boring. It was like listening to some people you don't know catch up from like being old friends a long time ago. Like they weren't talking about anything of consequence. It was just like friendly banter, and I think Powell kind of maintained the same sort of position and tone from a couple weeks ago in Jackson Hole. But it wasn't, it didn't have any teeth. It was just like, I think the market probably bounced a bit just because he didn't say anything crazy. Um, I think he's saving whatever he's going to say that might be crazy for the upcoming meeting, which should end on Wednesday the 21st. So we got a couple of weeks before the next Fed meeting. Between now and then, they'll be looking at data, figuring out what they're going to do. As far as raising rates, seems like they're raising by some amount. We won't know what until we get there, but probably 75 basis points again, maybe 50, maybe 100 basis points, who knows? And then he'll do a press conference afterwards, and we'll see if he dials up the rhetoric or backs off at all. So, I mean, either way, I don't think there's a whole lot of reasons to be bullish coming out of the Fed. They're doing their quantitative tightening deal, which they're stepping up the levels of, or at least have permission to step up the levels of that quantitative tightening this month in September. So raising rates and quantitatively tightening, QTing, whatever you want to call it, is it's not going to be good for asset prices. So
yeah.
um, so yeah, not still no reason to get aggressively bullish.
Yeah. And I'm looking at the SPY chart here, and what I'm seeing is we have the 50-day moving average here. Is that right? Yeah, so on the red one there. And we came up and hit that today, and we're not closing above it. And it could take a little consolidation, but what's scary and why this just feels like a coin flip is you have a rally into the 50, doesn't close above it. You also came down and hit this 390 level that's definitely a fine line. So if we break under 390, I just see a lot of fear, panic selling, and that's where you could see a fast move down. And it's going to take a day or two, I think, to really tell us what's going on. But this is just a spot where I don't see a lot of reasons to be bullish fundamentally or technically. And if we roll over here, it's going to get ugly.
Yeah, I mean, the only thing I see that's even remotely bullish, I don't even know if I'd call it bullish, just not bearish maybe, about that chart is at the bottom where the MACD is actually starting to show some positive momentum. I mean, it's still negative overall, but less negative. So it's creeping up towards that zero line. So I mean, yeah, who knows? That could all reverse very quickly. The wrong headline comes out, or just somebody wants to hit the sell button. I think over the past couple of days we've seen some short covering. Market's down. The SPY is down. I mean, as of a couple days ago, it down 10% from its run in with the 200-day moving average. So at that point, that 10% drawdown, you're going to get some people covering their shorts, and so we've seen a bit of a bounce, up 3% from there. So I don't think there's a lot of people opening new long positions because they're very optimistic about the health of the economy or the stock market in general. And, maybe the Fed's going to back off and pivot to a dovish tone. I don't think anyone thinks that anymore. I think that ship sailed a couple Fridays ago in Jackson Hole. And so now everybody's just kind of waiting for the other shoe to drop. Tell you though, the one thing, and we'll get to a dollar chart here in a little bit, but the ECB finally raising by 75 basis points is actually, maybe will stop the dollar rally a little bit and slow down interest rates a little bit. But I mean, the European Central Bank just tightened from 0% to 0.75%, and inflation over there is like 12 or 13%, some crazy thing. I mean, maybe it's only 9 officially measured, but I think it's probably worse than that. At any rate, they're still at a rate that starts with 0. I mean, they went from 0 to 0.75. Like, it's basically 0 still. So they're not having any impact on inflation, but they might, a stronger euro will come from them raising rates. And so a stronger euro will also mean a slightly weaker dollar. Doesn't mean the dollar is going to drop hard. It just might stop going up as fast. And that would be a good thing for US stocks who sell a lot of goods overseas. So we'll see how that plays out. The dollar's due for a breather anyway, as you will see when we get to the chart. I know we've talked about it last week too, but it's only extended itself from there. So
yeah.
Anyway, yeah, I wouldn't be surprised to see some consolidation above that purple line and below the 200-day moving average for a few more days. But I also wouldn't be surprised to see the bottom fall out. So what will surprise me is a rally back above the 200-day moving average anytime soon. That would surprise me.
I agree. And just going to the next slide here. Or where's that one? Oh, sorry, this slide's looking different. I was looking for the long-term view of the S&P.
Yeah,
but
it doesn't look like you put it in there. It's all good.
All good. So, all right. I guess
so this is the
next
Qs. You got the Qs on your screen right now. That was Qs. I think that's Qs, man.
Perfect. Yeah, it is Qs. And it's funny, same chart, but here's one thing very different. Look at this. You drew this down, or this line of support.
Yep.
Broke below that, came back up, tested it, and it's looking like it might want to roll over.
Yeah.
That might be a bit of a leading indicator for the S&P. NASDAQ or the Qs being a little more tech heavy. You could see it go without that because you do have energy in the overall S&P. But looking at that, I mean, that thing starts breaking down. It could pull some other things with it.
Totally. Yeah, no, nothing bullish about that. There's, again, the MACD is turning up towards that 0 line, which, if it gets above the 0 line, it'll be positive momentum for a little bit. I don't think it'll get above the 50-day moving average, really. I mean, just hanging out there and kind of working off some of the selling that's happened over the past couple of weeks is probably more than enough to send it another leg lower. Not too far from now. Maybe give it 2 more weeks and the Fed comes out, raises rates, and dials up the hawkish rhetoric, and by then MACD will be green, positive momentum, and it can easily break down from there. So anyway, I don't see any reason to get aggressively bullish. I mean, it doesn't mean you have to hide under a rock either. There are certain stocks out there that look like they can, bounce and um, will be good long-term holdings and probably won't stop out of them. So we're looking for opportunities and take advantage of those opportunities where we see them. But again, aggressively going long is not something we're doing. We're still holding a lot of cash, and I don't see any reason not to.
Yep. And so I want to point this chart out. We've talked about in the past oil. It was so bullish, but there's a feed through effect on this one, and that is inflation. So energy is a huge input to a lot of what people spend their money on, and inflation. And oil, we had this nice uptrend, broke it, and then it was consolidating down here between, I don't call it $87 to $97. And here it just broke down through that. And I mean, I'm seeing support down here, maybe in the 60s. So
Yep.
that could bring inflation down. So that's a good thing, but definitely oil looks like it's breaking down. What are your thoughts, Shane?
Oil definitely looks like it's breaking down, and the OPEC coming out and saying they were going to cut production did not stop it from going down. So that's definitely of interest. I mean, we're it's after Labor Day now, so the summer driving season is over. I don't know when they switch back to the winter blend in the refineries and that kind of thing. But seasonally, we've seen the peak in gasoline prices anyway. So I mean, I don't. It's just normal, this time of year that those things kind of back off of their highs. So you know, I don't know. I don't see anything here other than are good reasons to go short. If I was trading crude, I would short the heck out of this. You get the 50-day crossing the 200 from above. You've got negative momentum and worsening. So, yeah, to me, this looks like all downward momentum with support certainly around 60. Most reports I've read recently, that's where the U.S. producers are profitable at $60 in oil or above. So I don't see it dropping too much below 60 for too long. And so as long as it stays above 60, those oil producers, exploration and production companies, should be able to make lots of money and continue to be good investments. So yeah, crude looks like crap, but I think the oil and gas companies in general still look pretty strong.
Mm-hmm. I agree on that one. And then Shane, this you put up looks like we're looking at energy and the forward PE, and I notice it's a lot lower than any other PE up here. So
Yeah, by
tell
a
me about
lot.
that.
Yeah, so it's the cheapest sector in the market right now. And it's much cheaper than the index overall. And on top of that, not only is it cheaper than materials and financials and industrials and discretionary and tech and everything else, it's also much cheaper than its own 20-year average. So if you look at the box right below the red one that I circled, the 20-year average forward PE is 13.9x. And so, I mean, we're only at 9x. That's a good, 30-40% below its historical average valuation. And there's nothing wrong with these companies. I mean, as far as economics are concerned, the price of oil is much higher than the cost for them to produce it. So they should continue to make money and probably should be valued a little bit more in alignment with their historical 20-year average. So I mean, that represents a lot of upside in energy companies from where I sit. Again, I don't think it's a good time to be aggressively bullish or long anything, but if you had to pick a sector to go buy, energy's got all the upside momentum. It's up the most this year, and it's still the cheapest. It's not very often that you find that combination. So if you're looking for a place to put money to work, the energy space is a good place to go hunting, and we're gonna hammer on that a little bit more. It looks like these slides. Oh no, yeah, the next slide is XLE. So this is the energy ETF, and you can see it's still holding above its 50 and 200-day moving average. We've got a series of higher lows that are connected by that upward sloping purple line. We've got some lower highs that are, connected by that top purple line. And so we just kind of have a nice little wedge forming, or a flag, however, whatever you want to call it. And it'll either break up or down from here. If it breaks down, as long as it holds the 200-day moving average, and really as long as it holds that 65.33 line, it's still pretty much in an uptrend. But what I see is that the MACD is already, been negative or red for a few days, and my guess is that we're going to break higher from here. So we'll see. Maybe it doesn't work out that way, or maybe it doesn't work out that way immediately. But if I had to go put money to work, this is where I'd be looking to put money to work.
Yeah.
So we actually sold some covered calls against XLE in the Elevate strategies, because we've been holding on to XLE for a long time. I mean, well over a year now. We're up, I don't know, 100% or so. I don't really know what it is. But I thought it was a good time to sell covered calls at 90, because I just didn't see it going above 90, in the near term. And thankfully that was right around the recent peak. It's drawn back a little bit, and I was actually looking to buy those covered calls back today for a little bit more than 50% of the premium captured. So I think we sold them for 95 cents a call, and I could have bought them back this morning at 43 cents a call. I think I'm trying to buy them back at 40 cents right now. So selling covered calls, it's not a bet that something's going to go down. It's just looking at the chart and saying, hey, I don't think we're going to see this price in X amount of time. And it's a good way to, place like a non-directional kind of bet, where you're like, I don't need the stock to go down. I just need it to not go up. I just need it to take a breather. And
Yeah.
so selling covered calls is a good way to just book some gains. And if we get called out at 90, so what? We're in much lower, so if somebody wants to buy our shares at 90, like we'll make a nice profit on that anyway. So
Yeah. And something nice to just point out here, sometimes it's this simple. 50 above the 200-day looks good. And then you have to just, take account for what has happened. Look at this monster rally. And when you have a fast rally like that, you're going to have some consolidation here. So wouldn't be surprised at all, Shane, to see it even break this line, come down, and just churn around for a little while. It's nothing surprising at all. But after a move like that, it might just take a little bit of time before it makes that next leg up.
yeah. Yep. Sorry, I'm just making a trade right now on my personal account. I got an alert to buy Tesla of all things. And so I just bought Tesla. Woo, let's go.
I was looking at that one earlier.
Let's go, Tesla. I hate that stock, but I like money, so whatever.
Yeah.
Um,
So then this one here, so declining flow of gas to the EU, does this happen to do with, little maintenance and turning off a switch? Or I know that
yeah,
certainly didn't help last weekend.
no, pretty funny. I mean, there are a lot of people out there talking about the silly sanctions that are going on. Like, we're sanctioning Russia and harm, like cutting off your nose to spite your face is what comes to mind. Like, why do this? I mean, I understand that people are upset about Russia invading, Ukraine. Russia sees it as their own territory. Like, what if somebody occupied Puerto Rico and told us we couldn't have it anymore? What would we do? We would go get it back. I don't know why we get involved with stuff like this. The World Police, Team America, World Police, right? But anyway, Europe is not wanting Russian oil, and so they're all talking about putting a global price cap on Russian oil, which, is just something to talk about rather than do. I don't think China is going to participate in that. I think China will pay Russia whatever they want for their oil, and there's not a dang thing anybody can do about it. But Putin's like, hey, if you guys are going to put a price cap on Russian oil for the people in Europe, or for the people in the world who want to buy it, how about this? We'll just turn off the gas flow. I mean, we'll just turn it off indefinitely. And so for now, Nord Stream 1 is totally shut down. There's no projected date on when it will go back online. And so what that means is all the companies, or all the countries that are looking for gas are having to look elsewhere, and that means probably the United States. So on the left side, you see America holds the world's 5th largest proven reserves of natural gas, about 6.5% of the total global supply. We also have proven infrastructure and export terminals for sending those resources abroad. It's funny too, because not that long ago, we were building terminals to import natural gas to the United States when peak oil was a thing. which is just ridiculous. But famously, Cheniere Energy went and turned all of their import facilities into export facilities. Like they had to turn them around. They were building import facilities and then they had to retrofit them to be export facilities because everybody was so wrong. So anyway, the bold part here, though, says, this energy intelligence firm Rystad Energy estimated earlier this year that E&P sector profits could improve by 70% in 2022 on a year-over-year basis. And like we said a couple slides ago, oil and gas sector is still cheap compared to all the other sectors and compared to itself. So it's got momentum, it's cheap, and the fundamentals are outstanding because of silly things like this. I mean, Russia and the whole world should back off of their sanctions, or not Russia, Europe and the whole world should back off of their sanctions on Russia and let economics be economics, let war be war, or conflict, whatever you want to call it. I mean, it's just not our business. And why would you want to hurt your own citizens through crazy inflation and freezing to death all winter just because Russia wants to cross a line on a map that they didn't draw and they don't really believe it? I mean, to me, it's just, I don't know. I don't know how people aren't voting differently to say like, hey, I don't really care what Putin wants with Ukraine. I want to keep my family warm this winter, and I also want to buy some Christmas presents. So turn the gas back on and leave them the heck alone, you know?
Yeah.
Anyway, it's just crazy to me that that's a thing.
Yeah. And what's interesting too is, price caps, they sound great. Yeah. Especially politically. Hey, we're going to cap it at, $50, let's just say for fun. Well, if somebody tells you you will only get $50 for producing a commodity, what do you think you're going to do? You produce less, right? I mean, if you're capped, I'm not going to produce as much, which means less rigs out there pulling oil out, which means less supply, which actually, turns it around, increases price.
Yeah, I don't know. It seems to me also like it benefits our enemies like China. If
Hmm.
you put a price cap in and Russia decides that they're going to produce less, or China says, well, hey, you can only get $50 a barrel for it anywhere else, so I'm only going to pay you 55, right? When otherwise they would have to be paying 80 or something. Well, it just means cheaper natural resources for China, our competitor. So we're really helping them out if it really worked. And other countries like North Korea, for example, who can now go and get even cheaper oil and gas from Russia. So and it's already come out that North Korea is supplying Russia with weapons and stuff. So I mean, all of this, all these sanctions are just making some of our other enemies even stronger. And I think it'll probably not work out for the best. There's also
Yeah.
some tickers down there at the bottom. Like if you're looking for tickers that you want to trade, no, go
Oh,
back. Go back one. I put them on a couple of different slides. So at the bottom left there's a few tickers that you can take a look at. We'll get into a couple other tickers on the next slide. I just kind of, as I was putting in those tickers, I made the next slide. I was like, well, let's go see what tickers are all in XLE. So if you want to go to the next one, Kyle, this is a look at the XLE ETF. And so you can see all the fund holdings. There are 21 holdings in XLE, starting with Exxon and Chevron and Conoco, the big ones. Really, Exxon and Chevron make up like 43% of the fund,
mhm.
which is pretty wild. But there's some others in there. EOG is my favorite oil and gas ticker. EOG is I think one of the most efficient, best producers out there. And then the other thing too is I threw some uranium tickers on this slide: URA, URNM, CCJ, DNN. CCJ is my favorite ticker in that space. It's the actual miner. URA is the ETF. But everybody needs energy, and as oil and gas get more expensive, people are going to continue looking to uranium and nuclear to solve some of the energy needs. So I think that's worth paying very close attention to.
Yep. And then here's our, our favorite chart of the week every week, gold. Just
Speak for yourself. Just take this thing out of here.
yeah, maybe we should. Basically what you have here is they call this a bear flag. So, after everything here, we had this little consolidation. Wouldn't surprise me one bit see it go down, especially the with interest rates rising and the dollar just being bullish as heck. Buying gold right now again, chaos hedge, great. Investment, just couldn't be worse.
Yeah, I don't know. I think momentum's finally curling up a bit. I think we might hold this higher low from like the July lows down there. So I'm kind of constructive on it. I don't really see it breaking below that 1673 level. So um we have it as a long-term holding, physical gold, and I think this is a fair place to accumulate a bit more. We were trimming our position a few weeks ago, around 1800, because you could kind of see that was going to roll over and not last. So yeah, we don't trade this thing. We hold it for the long run, but I think you can get away with accumulating some here, and as long as we hold the 1673 level, I think you can keep accumulating. So definitely a good chaos hedge, and certainly, as I was mentioning earlier, if the dollar starts kind of pulling back as the European Central Bank starts to hike interest rates, they need to go a little bit more aggressively than 75 basis points. But if they do that, that'll kind of take the wind out of the sails of the dollar. As the dollar decreases, gold should rally, or at least have a little bit of wind in the sails. So I'm constructive on gold here, but again, not as a trade.
Yep. And then here's Bitcoin, the other, gold category asset, chaos hedge, offset inflation. That's what they tell you. This thing, it still to me just looks terrible.
Yeah, I don't know, man. I didn't draw this chart, so we're doing this call a little late today. It's like the last hour of trading, and I didn't get to draw any new lines. I would have drawn a line, a new purple line there connecting the recent lower highs. And again, I see the momentum, the MACD kind of curling higher, and I think we could get a breakout of this. Call it a bull flag if you want to, but I think that we could break a little higher, at least up to the 21,940 level, which is where the 50-day moving average sits at this point. It's going to take a little bit of work to get above that level. So I'm not real optimistic that it's just going to go in a straight line higher, or anywhere near the 200-day moving average at around 30,000. But I do think eventually that'll happen. I would not aggressively be buying Bitcoin here, but again, kind of like gold, if the dollar kind of starts dropping, that should support the Bitcoin price a little bit. These are big ifs, by the way. There's no guarantee that will actually happen. The European Central Bank could just as easily take rates back negative next week because they're chickens. I mean, I have no confidence in anything that they're doing over there. So we'll see, but I do see momentum kind of curling up, maybe going positive, and could be a good spot to buy. Again, with your stop at the recent lows here, you're not risking a whole lot to take a shot at it, but I think there are better opportunities out there in the market.
Yep. And here's one, Shane. So I put this chart up, and 10-year treasury or interest rate. What I want to highlight is we're coming up here right at this high that was set back in June. You could see that as a double top forming. But more importantly, something I've just been noticing a lot is a lot of commodities are rolling over, and I'm actually seeing the long end of the curve move up. And that just kind of sets the stage, I think, to take out some of that inflation, that things are working a bit. But is that going to stop the Fed? I no idea, but just an observation I've seen where if you saw this start reversing right here and inflation come down, that could be a bullish backdrop, but that's pure speculation at this point.
Yeah, I haven't been paying too close of attention. I don't know what this white line from July 27th is, and I haven't updated any of the drawings here. So obviously we broke out of that purple line that was connecting the lower highs. When we broke out, it came back and back tested that purple line, and then just has rallied ever since. Now I see the momentum on the bottom starting to kind of roll over. And like as you said, if we had drawn the line from the recent high, the all-time, not the all-time high, but the cycle high so far, right around 3.5%, we see that we're getting pretty close to running into that double top area. So sorry for the lack of updated drawings on this chart, but I didn't know Kyle was going to plug it in, so I just never got around to it. But yeah, I could see this kind of, going sideways for a bit, consolidating, and then probably going higher if they keep doing QT here in the United States and they keep raising rates. Ultimately, couple months from now, this will be even higher than that 3.5% level, but it's not going to get there in a straight line probably. So again, as rates go higher, that's harder for the QQQ, the tech companies, comparatively to the S&P 500. So look for some shorts in the Nasdaq if I were you.
Yeah, and here's the chart we were just kind of talking about, but US dollar, and I got to move our image out of the upper right hand corner because this thing just seems to be 45-degree angle up and to the right. Dollar's been a great investment. I don't know what else to say, but this thing just seems unstoppable.
Yeah, I think you need to update the text on there too. It says up 18%. Looks like it's up a little bit more than that at this point. If you were to do the, I don't know. Looks like you just plugged the chart in, but didn't update kind of any of the stuff in it. So I don't know what the dollar's up. It's probably about 18%, maybe 19, maybe 17. I don't really know. But that was an old thing that I wrote, I don't know, a week or two ago. So I don't know that that's actually correct, but we did break out to a new high over 110. So yeah, I don't know. If I looked at this chart compared to the S&P 500, I know I'd rather own this chart than the S&P 500 chart over the past 1 year. So holding dollars is, as much as everybody likes to say, holding dollars is eroding your purchasing power to inflation. Well, holding the S&P 500, which is down 20%, or was down 24%, eroded a lot more purchasing power than holding dollars by comparison. So
Yep.
again, though, I mean, if the ECB continues to raise, this is the dollar compared to other currencies, and the euro is the largest component of that other currency basket. So as the euro gets more valuable due to rates going up over there, that will kind of put a lid on how high I think the dollar can go in the short run. So we'll see what happens, but yeah, dollars have been good.
Good stuff. And then what do you have here? So we got some mortgage data, it looks like.
Yeah, well, I got tired of looking at the trading view version of mortgage data because it gets updated on Thursdays, which means the trading view chart gets updated on Friday, tomorrow. And so we're always like a week behind. So this data came out this morning from Freddie Mac. So I just went straight to their website and got it and put their chart. So we can't draw anything fancy on it. But 5.89% is the highest mortgage rate we've seen since 2008. So that, the chart in the bottom right, the larger one, is the past 10 years of mortgage rates. So that doesn't go back to 2008. The top left is like, I don't know, I think only a month long or something, or maybe 1 year, goes back to September of last year. So mortgage rates have been steadily climbing for the past 1 year, as you can see in both of these charts. Makes houses harder to afford, so housing affordability is decreasing, which is what the Fed wants to do. That's how they're going to kill inflation, is by killing demand and making things unaffordable for people. And as sad as that is exactly what we need to do, because they printed too much money and gave it away to too many people, and that is what caused prices to go way higher. So mortgages are definitely more expensive. I'm glad you got yours done during that little dip recently.
Yeah. Saved me a
I mean,
little bit.
honestly, how your mortgage payment, I don't know if you've done the math, but at 5.89 compared to wherever you got it, I mean, your monthly mortgage payment probably would be 10% higher if you were to go do it today versus like 3 weeks ago. I mean,
Yeah.
it's a crazy number. And like for myself, if I had to pay that rate for the house I currently live in and pay the price that my house is now, worth on paper, I would not be able to afford my house. Like
Yeah.
I would not live here. I would live somewhere that was smaller or in a worse neighborhood, or, not as nice. So it's I'm blessed and I'm happy and I'm glad I got mine done. Mine starts with a 2. My mortgage rate starts with a 2.
That's
2.99, man. And I didn't pay any points for it. That's just the number I got.
yeah, that's a really good number. So
It's ridiculous.
nice work there. And then so this chart, we bring this up regularly, but again, just highlighting the rallies. This is the 2008 Great Financial Crisis. You had a rally 14%, 9, 20, 26, but by the time it was all done, down 57%. So, it could definitely happen again. So let's
A
wait
20,
for,
a 26% rally does not kill a real bear market. And our most recent rally was nowhere near 26%. I think it was like 16, 17. So we are not out of the woods yet by any stretch of the imagination. We could just be getting started.
yep. And then Shane, here's your car trade. And,
Hmm.
I hear you cracking up a little bit in the voice. I don't know if it's the car trade hitting your stop or if that was just an unemotional, exit. You got out and you moved on. Which was
Yeah,
it?
I don't care. I'm not missing it. I was right, but I stopped out, and so that's it. When the price goes above your stop, in the case of a short, you buy to close and you move on. I could have got back in if I wanted to. I just didn't, and so we'll see what happens from here. But I don't like the setup as much now. I don't think there's enough downside left in order for me to take the risk to get back into that short. I didn't even think so the day after I got out of it. And so that's just how it works sometimes. I mean, you can't win them all. The idea is to keep the losers very, very small and the winners as big as you can get them. So this is a small loss for me. Lost a couple $100, had the potential to make a couple $1,000 at least. And that's how it works. So you get rid of the bad ones quickly and move on. Sometimes it turns out that you did it at the exact wrong time, and there's just nothing you can do about it. You move on. You go on to the next trade and you see what you can do.
Yeah. And I think the big thing people get caught up in is they look over here on the left and they say, oh, it's a $300 stock. Well, I'll keep holding. It'll go back. It's been there before. And not getting out right here, more often than not, you can see this just start going lower and lower until, you're holding it and you're down 50%. So,
Yeah, most people are long that stock. What if I zoomed out a little further though, you would find out that it also used to trade at $7. So I mean, it traded as high as 543 back in November of 21 at the peak of this most recent bubble, and it traded at $6.60 at the lows during COVID. So quite a wide range. I think car is more likely to go back to $6 than it's ever likely to see $550 again. And so I'd be shorting that thing every opportunity, but it needs a breakdown further from here. If it drops below like 141, I'll short it again, but it's got a ways to go.
yeah. And here's Trip. So, looks like same thing. So, just broke below that average, hit that stop, and maybe
No,
it's
no, no.
trying to.
I was short these, dude. I'm not
Oh,
long either of these stocks. I was short both of them. So went my way. I stopped out on the spike above the highs of the day that I shorted it. Same thing with car. I shorted it um the day that green line starts. I shorted it that day and it dropped way down and then rallied back higher during the day. So my short was opened on that day where the green line begins, the day before the white arrow. That was when I opened my short, and my stop was the green line. So if it went above the green line, that's where I'm getting out. And I don't always do that on a closing basis when I'm that close to the entry. There's no telling how high this thing could go. And so I shorted it. The next day it rose above 2362. I covered my short. Now I'm out. And today it trades at 2444. So if I hadn't covered and I was still holding on to it, I'd be down a bunch on this short because it ain't going down, it's going up.
yeah.
Now it's running into the 200-day moving average, and I'm going to look to short this thing again. But you see momentum curling up. You see the 200-day moving average in play. If it goes above the 200-day, this might actually turn into a pretty good long opportunity. It's breaking out, and it might go much higher. So just because I don't like something and I short it, does not mean it's going to go down. Geez, I wish it worked that way. I'd make a lot more money trading.
Yeah.
But that's the same deal. Is you keep your losers small, you cut them short. Like get out of losing trades. I'm allergic to red. I don't like seeing losses on my screen. Like it messes with my emotions, and so I don't like holding things that are down for any length of time. If a trade's going against me, I'm wrong, and I get the heck out immediately. Um, that's just all there is to it. So both of these trades went against me. Turns out that car ended up going my way, but not before it stopped me out. So, yeah, I was short both of these things.
Got it. That makes sense. So, all right. And this one, got my little toolbar block in the top here.
Yeah,
But
we're gonna have to wrap this up pretty quick because we only got 15 minutes left in trading, and I got some trades I need to make for the day. So, um, all you're seeing here is on the right hand side, the average bull market goes up 162% in 51 months. Can you get your little red pointer on that? The bottom bar on the right, there you go. And the average bear market goes down 41% in 20 months. So far, this current bear market that started in January 2022 has only dropped a total of 24% and has only lasted 5 months. That's nothing. There could
yeah,
be a lot longer to go. Now, maybe not. I mean, some bear markets are very short, like the COVID bear market was only 1 month long, but it did go down 10% more than we've seen it drop this time. So, but looking back through history, the averages are pretty important. Doesn't mean that we're going to get there, right? An average is just an average. It doesn't mean anything. Um, but I thought that was interesting that, this bear market hasn't even gotten close to the average yet. And I think there's a lot of good reasons to think that it could be much worse than average given the current situation and environment.
yep. And then here's just contributors to headline inflation breaks out between energy, restaurants, food, shelter.
Yeah, and the
Mm.
interesting thing is the other restaurants on shelter are the sticky forms of inflation. The food, energy, and new and used vehicles are more transitory. I don't know if I'd say transitory, I'd say volatile. They're more volatile. They go up higher faster, they go down more faster. But here's what's important is that the ones that are deemed to be sticky, the shelter, the restaurants, and the other, are above 4% all by themselves. So if energy, new and used vehicles, and food at home all went to 0% inflation, we'd still be above 4%. Meanwhile, the Fed is targeting 2% inflation. So they got a lot of work to do. Rates are going to have to go much higher to get inflation under control.
Yep. And then this one,
Oh,
just
and higher rates destroy you bonds. Anybody who came into this year with 60% of their money in a stock ETF and 40% of their money in a bond ETF is just getting killed. Just getting killed. That's supposed to be a conservative and diversified portfolio. The bonds are supposed to zig when the stocks zag, and nothing further from the truth has happened this year. Like that, it's just bad. And if your advisor hasn't told you to get the heck out of bonds yet, you got to call them and ask them what the heck they're thinking. Like, why? Why haven't you gotten me out of this trade yet? Like, this is awful. And
yeah,
maybe we're near the bottom now, and maybe this is the wrong time to go sell all your bonds. I'll give you that. Should have done it months ago. But if your guy didn't see it months ago, you should probably get rid of that guy and find a different one. Like, I'm sorry to mince word, or sorry, I'm not mincing words here, but I mean, if you can't see that, you probably should find a new line of work to get into, like just be a stock trader or something because you clearly can't see the bond market. This was a telegraphed move. You should have been getting out of bonds in November, if not 2 or 3 years ago, you know? So, yeah, it's just unacceptable if you're still holding all those bonds and nobody said anything about it. That's irresponsible, and you can do better.
yeah. And then last one, Shane, California's new energy source. So
Yeah, we talked about it last week. We said Gavin Newsom was gonna mandate wind-up cars, and so this time we're gonna do hamster wheel charging. So get a hamster wheel for your garage because we're shutting down the energy grid. We're gonna ask you not to charge your electric vehicles, but we're also gonna force you to have an electric vehicle and not use an internal combustion engine. You just can't make it up. So our
no,
friends at the Babylon Bee have a good sense of humor, and they put this guy on a hamster wheel to charge up his Tesla. Now, I know that there are people out there who probably think that's actually a good idea and might even give it a shot. More power to them. I'm gonna keep putting gas in the car.
yep. So perfect. Well, Shane, as always, enjoyed our conversation and hopefully anyone watching did as well. Be sure to like and subscribe, and we'll catch up again next week.
Later, y'all.
See ya.